Peter Lynch once admitted that one of his biggest investing mistakes wasn't buying the wrong stock, it was selling the right ones too early. That's a surprising confession from one of the greatest investors in history, but it's also one of the most important lessons you'll ever hear if you're serious about building wealth. Think about it for a moment. Most people worry about picking winners, but Peter Lynch discovered that the real challenge begins after you've found one. The temptation to lock in a quick profit can be stronger than the patience required to let a great business keep growing. During his remarkable run managing the Fidelity Magellan Fund, Lynch invested in companies that went on to become household names. Some multiplied several times over, while others became what he famously called 10-baggers, stocks that increased tenfold or more. Yet even he admitted that he sometimes sold exceptional businesses because they had already doubled or tripled, only to watch them climb another 10 times in value. Why does this happen? The answer has less to do with investing and more to do with human psychology. Our brains are wired to celebrate certainty. Selling after a gain feels like success because the profit becomes real. Holding on, even to an outstanding company, feels risky because tomorrow is uncertain. We often fear losing what we've already earned, more than we value the possibility of earning much more. Imagine planting an apple tree. After the first season, it produces a small basket of apples. You could chop it down and enjoy what you have, or you could let it mature into a tree that feeds your family for decades. Great businesses are much the same. Their greatest returns often come long after the initial excitement has faded. Lynch's investing philosophy was never about predicting the market. It was about understanding businesses. If a company's earnings continued growing, its competitive advantages remained strong, and its future looked brighter than its past, there was little reason to sell simply because the stock price had risen. This lesson is especially relevant today. In a world of constant market updates, social media opinions, and daily price swings, investors are encouraged to react instead of think. Many sell winners at the first sign of a profit, while stubbornly holding on to losing investments, hoping they will recover. Lynch warned against exactly this behavior. He famously observed that people often pull the flowers and water the weeds. It's a vivid reminder that our instincts can work against us in the stock market. Of course, this doesn't mean you should never sell. Businesses change, industries evolve, management can lose its edge, competition can intensify, or a company's valuation can become disconnected from reality. Selling should be based on changes in the business itself, not simply because the stock has already rewarded you. Perhaps the greatest investing lesson Peter Lynch ever taught wasn't hidden in a complicated financial model. It was the quiet discipline to let exceptional companies continue doing what they do best. Wealth isn't built by constantly chasing the next opportunity. More often, it's built by recognizing that sometimes the hardest decision is also the most profitable one, having the patience to stay invested when everything inside you wants to cash out.